Today we're going to focus on operational risk and technology risk. A little bit more detail. We spoke about them last week, and for the 3076 group, we'd have done a little deeper dive on operational risk and why it's important to look at it, and why the BIS, for example, did an entire study of hundreds of banks, maybe thousands of banks in some countries, to see what data losses they would have had, and that those turned into money, right? And what it is that financial institutions, banks in particular, need to put in place in order to mitigate the risk. So, of course, with operational risk, so after today, you should have a very good understanding of operational risk, what it is, what are the causes of operational risk, and also, of course, how that affects financial institutions, right? So we know that all risk expose the financial institutions to financial loss. And we also know that all of the risks that we have identified have the potential to put financial institutions under. In other words, make them insolvent. So operational risk, by way of definition, is the risk of direct or indirect loss because of inadequate or failed internal processes, people, and systems of external events. Now, the text is saying that approximately 20% current capital charge. In other words, at the time that the book was written, there's at least 20% of operational risk charged to capital. And for those persons who looked at operational risk yesterday in 3076, they would have seen the magnitude of the amounts of losses that were caused by operational issues. And we know that those can come from not just inadequate or failed processes, but from people not doing the right thing, from straight out fraud, all right? And when systems are weak, you end up exposing your institution to fraud, because you can have internal and external parties working together to commit fraud and cause loss in your institutions. So, what are all the risks we identified last week? I know we said it before, but we're going to say it again. What are all the risks we identified? Credit, interest rate, operational, technology, liquidity, insolvency. Any more?
Underwriting.
Off-balance sheet risk. Yes.
Market risk.
Market risk, yes. Foreign exchange risk. Okay? Another one. Just feel lopsided. Alright, so those are the key ones. But we know that those are the risks. However, when you dig deeper into all of the activities of financial institutions, there are a lot more risks that they're exposed to. So when you look at something like interest rate risk and you break it down, you recognize that we have what? Refinancing, reinvestment, what else? There's another one. Repricing, right. Okay? So all of those fall out of the interest rate risk. And um, when you break those down further, you recognize that there's a significant amount of losses that financial institutions can incur. All right? So you have the risks, which are going to add to the cost of the institution, but you also have all of the other things that go into the institution. So there's a risk that we didn't really speak about, all right? It could fall on the operational, but it's a whole risk unto itself. Legal risk, all right? When these institutions enter into contracts, they have legal risk. Because if they breach a contract, all right, and there are many that they can breach, including employee contracts, there's a risk. And so that's why when we started at the beginning, we spoke about enterprise risk management. So financial institutions now have to focus on enterprise risk management, and they need to have a framework for dealing with their risk. And that is what enterprise risk management is about. And so you start from the very top and come down. So how do you manage all of these risks? There were some suggestions out of some of the work we did yesterday. So it means your board and your senior management need to be monitoring. They need to have processes, procedures, policies in place to help to monitor and to mitigate, right? So what we are going to be talking about more today is how management, what management has to do to be able to control what is going on in the organization that leads to loss, right? So mainly the operational side we're talking about today, okay? Then you have the technology side, because you're using technology to be more cost efficient, right? You're using technology to be able to offer more products and services, right? And so you're also using technology to reach more people, more customers than you would have normally reached, right? So the technology is a critical part of the operation. Now, if that technology does not give you the savings that you expected, then you know you're facing technology risk, okay? So, like it says here, technology is not just a distribution channel, but a different way of providing financial services. All right, so we will look at both. Now you'll notice here that there are 5 categories or sources of risk, of operational risk. And the main one is technology. All right, the main one is technology. So if your technology fails, then that is a major risk. And when we talk about technology, we're not just talking about the computers they use, but we're talking about the software that's installed on the computers. We're talking about the linkages between the computers. So in an organization, in a financial institution, you have a lot of software, right? You have systems, use systems to do everything. So you have an HR management system. You have your HR management system may be separate from your payroll system. Then you have your accounts. Your accounting system may be separate from your operations, right? So the systems all need to speak to each other. Then you need to store your data, right? You need the equipment to store the data.
Yeah.
And so all of these systems have to be networked. If they're networked, you need what? You can network on a cloud, but most networking is done by cables in our part of the world, right? Because if you're not networking with cables, it means you need Wi-Fi, which means you need what? You need electricity, you need internet. There's so much that you need. And so failure at any point in this technological infrastructure creates a problem. How many of you woke up when the electricity went down at some ridiculous hour?
I was there.
Of the night.
I was already
Okay.
up.
So if you were awake and studying, doing work, that was the end of it. You have no light, you have no internet, you have nothing. All right? And if you're like me, you have no fan. And you need the fan. Fortunately, it was a little cooler.
Right.
But it just goes to show how everything is so connected, and without the electricity, you have a problem. Right? I was going through my messages and noticed that the coach for the swim team my daughter used to swim with put a message in. Is electricity off in the area where the pool is, because we don't have a backup generator, which means they can't swim until it gets bright. And they start swimming early. They start swimming by 5:30, right? So they need light. So simple things like that. All right. Then you have your employees. That's one of the major categories. So human error and internal fraud, main things. Anybody has the information from yesterday where you saw what the internal data losses were, the categories? Anybody still has that?
That information on the finance.
And what were the data losses? What were the main ones?
I know that they accumulated, I can tell the amount that the banks accumulated in losses.
Oh, yeah, okay, so you don't have the actual,
No.
what the differences were. Okay. And I don't have it saved,
You have
that
it?
page saved in this computer. But they looked at things like fraud, all right? They looked at things like errors, and those were material, those were major, all right? So included on the employees, there's also market risk. Why? Why would market risk fall on the employees? Because it is employees that are managing the portfolios, right? And if the employees are not monitoring and responding to the market risk and making changes in the portfolios, then they end up losing money. So all of the other risks are somewhat connected to operational risk, right? And that's why I'm doing it first. Now, customer relationships. So customer relationships are a source of operational risk, because you have a contract with your customer as a financial institution. Let's take a bank, it's the easiest one to talk about. You have a contractual relationship with that customer, right? And that customer, through no fault of his or her own, loses money because somebody in your organization has gone into the person's account and use their debit card. They get the number, they use the debit card to commit fraud. So you not only have loss due to fraud, but you have loss due to a contractual dispute, because the institution would tell the customer, all right, give me time to investigate. Customer ain't waiting for time to investigate, customer wants the money back. So they institute legal proceedings, right, against the bank. That's a legal risk right there. So you have you have the loss of where the person took the money out of the customer's account, which is a loss to you, the financial institution. But now you also have the loss due to the legal the legal, or let's call it the suit filed against the company. Then of course you also have other major contractual arrangements with customers that can result in operational risk. Capital assets, destruction by fire or other catastrophes. All right? Then there's being external fraud. So at least 5 categories. Technology, employees as sources, employees, customer relationships, capital assets, and external being external fraud. With the technology, we have cyber security issues, right? So companies are exposed to cyber risk, cyber crime. And so financial institutions must put measures in place to ensure that they can mitigate against those risks, right? When you look at technology, it's saying here that US banks alone spend $20 billion in technology related expenditure. $20 billion. That's for all the banks in the US. But when you look at a single bank, and you look at how much they spend on technology, and then you look at the losses, on the study done by BIS, the average loss in operational risk was 1,391 million. That's the average loss that they found in the per institution in the US it was, right? So it relates back to this $20 billion a year that they spend in technology. Now, if you spend $20 billion a year in technology and you do not receive the benefits of that, that's a risk, all right? So that $20 billion in technology, you are spending that because you want to reduce your costs, all right? You're reducing your costs because where you may have had staff doing some little things, and you have to pay, you have to pay that staff their salary, you have to pay benefits, you have to, if there's statutory deductions like us here, the company has to match those statutory deductions. And so you bring in a piece of technology that over time, it spreads the cost. So your marginal cost or your per unit cost is less than if you had 2 bodies doing that, right? Efficient technologies should help to increase revenues because you are now able to reach more customers, right? So that's how technology, one-way technology can assist. And the technology also assists with reducing your operating costs, okay? That's important because the success of an organization tends to revolve around its ability to be able to meet its operational expenses. If a company cannot meet its operational expenses with its operating income, that company could as well close down. Because that's just the operating side. That's where you're getting your money from. And then when you add the other costs to that, the company really would fold. Okay, so financial institutions, so banks, insurance companies, their operating expenses need to be met by their main source of business. So for insurance company, by their premiums that come in, for banks, by the loans that they issue. All right? So they need to make that money, and hence they spend a lot of money in technology to reduce other costs so that they are able to have a surplus of operating income over operating expenses, right? So the point that they're making here is that technological innovation or technological investments have the potential to increase the financial institution's net interest margin. All right? What is interest margin? What is net interest margin? Net interest margin is interest income minus interest expense. Okay, so that's your net interest margin. And then when you look at, so they are investing in the technology so that they can reduce their other expenses, all right, such that their net interest margin and their net interest income is positive, all right? So if that is positive and then your other income minus your other expenses is positive, then you will do well. But you also have to include there your any losses, and the losses mainly come from loans. All right? How is it that interest income increases with investment in technology? So you have significantly more products, all right? So your range of products is wider in terms of income. So the products that you are presenting, so you have different types of loans, you may have credit cards, you may have different categories of credit cards, all right? So you're reaching different audiences with different products. And so with that technology, you are able to make more interest income because you are selling your product to a wider range of people, and you're selling more products, all right? You could also cross-sell. Cross-selling meaning you're not just selling to, let's say, your retail customers, but you're selling to your business customers, you're selling to your small businesses, for example. So one of my pet projects is looking at small businesses and how financial institutions can help them to do better, right? What products they can, small financial institutions can develop for their small business sector. The only way they're going to know what the small business sector needs is to be able to reach them, to be able to create like a unit within the bank or a group of people within the bank who bank or the financial institution who will focus on these small business people. And so you use the technology to reach them. So you'll notice that a lot of banks now, they are using social media to advertise their products, to reach out to their customers. And in doing that, they're using technology to widen the scope. So whereas before, they may just have been trying to reach the well-established businesses, they're now looking for all of you who may have your little micro business, you start your little business. Ashanti, right? It was you that said you have a small business. All right. And I'm sure there are others, but y'all won't have, that's okay. Okay? So they're now trying to reach, and the way they're trying to reach is using the technology. And as they use the technology, they can also sell more products, they can advertise more products, so that will increase their interest income. They can decrease their interest expense. How can they do that? All right, it says if access to markets for liabilities is directly dependent on the capability of the financial, of the technology in the financial institution. So one example, the ability to originate and sell commercial paper is increasingly computer driven. So no longer are they calling up the clients, right? To sell their commercial paper. You all know what commercial paper is? Commercial paper is a security, is an instrument, a short-term instrument sold by commercial banks where um, they will create the instruments for companies, where the company will purchase the commercial paper at a discount. It's an investment instrument. So those they're saying are more computer driven. Okay? And they can also increase other income. So remember, the main for financial institutions, their main income for banks in particular is what? Loans, interest on loans, right? So they can increase their other income. They can get involved in more purchase and sale of securities. So they make themselves a one-stop shop for their customers, right? So they can increase their other income there. And then they can reduce their non-interest expense. And of course, in financial institutions, you have what you call the front office, which is the people you see, the people that's offering the service, and you have the back office. So in a commercial bank, it's not just the tellers that you see and the customer service reps and so on. There are people in the back office, as it is called, that are ensuring that the money gets counted when businesses drop off the cash, and that is sent to the account. There are people in the back office who make sure that when you request a wire transfer, that wire transfer goes through. There are people in the back office who make sure that there's money in the bank's accounts at other banks to cover these transactions. So you see the customer facing people, but there are people in the back office who do some very, very important work. So they can reduce non-interest expenses by technology can reduce non-interest expenses by improving the processes in the back office. You remember? No, y'all not gonna remember. Nowadays, the tellers don't count coins. What they do? They weigh them.
Okay.
All right.
Because I went the other day because I had like a bunch of 10 cents and 5 cents,
Mhm.
a lot.
Yeah,
And
separate them.
They told me to put them into 100 pieces.
Mhm.
So that's why.
Yes, and they weigh them. So no longer they're standing up, they're counting. They weigh them. No longer they're standing up counting the notes if it's a lot of notes. If it's just a couple $100, even a couple thousand, they will count it, but they'll still run it through that counter, all right, to make sure that they save time. It's accurate, and some of them count it twice and still run it through it. But I do understand why the notes now, the notes and the counters don't work so well together, but it's getting better. So even that technology is improving, right? With the ATMs, when the new notes first came out, the ATM, you could have notes sticking together and you get extra money. That is improving. So they're using different ATMs now, all right, in the financial institutions. Even coming away from banks, in the past, if I purchase a bond or a stock, I would get a physical certificate to say I am the owner. Now the technology is there, you don't get that physical certificate. Maybe once a quarter or twice a year, you will get a statement that's generated by that same system that records the information to say you own this amount of shares or you own these securities. So we see those improvements in technology that actually reduce the cost, because paper is expensive. Paper is extremely expensive. All right, so removing the paper helps. Okay, so let's have a look at, we spoke a little bit about this earlier. So legal liability, all right? That's one type of operational risk. Then you have regulatory compliance and taxation penalties. So if workers make errors, all right, if workers don't follow the policies and the procedures set out by the regulator, then the regulator will fine the financial institution. If an insurance company does not send in its reports regularly, the reports that they have to send in, the regulator will fine the insurance company. So that's part of operational risk or loss due to human error. Yes.
So question, so if the error is on the employee, do they like put aside funds just for that, or do they take it out of the employee's salary?
Depending on what it is. Depending on what it is. If the employee does it a few times, the employee probably lose their job. All right. With fraud, depending on the amount, the banks, for example, will give the employee a loan to pay it back. Yeah, they've done that. Because remember, you also have reputational risk. So if you're going to dismiss the employee, right, and people are aware that you have employees who are stealing, it affects the reputation of the institution. So some of them, they will dismiss the employee. If it's the first time and it's not, I guess they have their thresholds. They may not dismiss the employee, but rather give them a loan to pay it back. But usually the loan to pay back would normally come like, sometimes it's genuine errors where the employee doesn't balance at the end of the day, right? And it's a significant amount. The employee has to put it back in. Okay? Right. So that's the regulatory compliance and taxation penalty. Then you have loss or damage of assets. Okay? So reduction in the value of the firm's non-financial assets and property. So that's a risk. That's operational losses. Client restitution. Client loses money because the bank card was compromised. You have to pay back the client. All right. I think now the bank has thresholds as to the amount. Depending on the amount, you will not get the money back out. If you can't prove, huh? It is. If you can't prove that your card was secure, they will tell you, well, that was your fault. All right. If it's not a case where, if it's like you left your card in the house and one of your relatives used it, you ain't getting money back. But in instances where there is, well, not cyber, I wouldn't call that cybercrime, but you have these people who travel around the world, and they have these devices where they push it in the ATM, and it gives your information. And when you leave, when you think you take your card out, they're able to go in and take money out of your account. When those situations occur, you eventually will get back your money. Because they know, they can see, they have cameras at the ATMs, and they now can tell you, they now know if somebody looks suspicious. Right? And some banks have the camera right inside. It's not looking down at you, but it's right in there, looking, facing you, so they can see these things. Theft, fraud, and unauthorized activities, of course. Transaction processing risk. Transaction processing risk has to do with the back office, where somebody may make an error in the back office, and so the settlement of the transaction doesn't happen at the time it should happen, and so the bank would lose money there, especially if it's like a foreign currency transaction, or you don't give the bank sufficient information and the money doesn't go where it's supposed to go. That money gets lost and the bank has to spend money trying to recoup it. So that's that's transaction processing risk. All right. So what I discussed so far was mainly on the retail banking side, all right? And just general banking. Now, in the US, there's something called wholesale. You have retail banking and wholesale banking, right? The retail banking is like with the customers, with us, individuals. Wholesale banking tends to be with companies, companies needing certain services that the bank will offer, all right? So in wholesale banking, the technology helps to improve cash management. Cash management meaning the banks have these services that they offer to their large clients, and based on the services, they set up accounts with them, all right? And you have, so you have something called, you have the control disbursement account, so larger customers, that's a product that the bank offers to them. You have account reconciliation functions. You have something called a wholesale lockbox, an electronic lockbox, where the bank holds funds on behalf of, and there's some other services that banks offer to large customers, and you have fund concentration. So companies will have multiple accounts, right? And governments, for example, do that. They have multiple accounts in one institution for different causes. So you would have, let's say you have customs depositing their revenues in one account, inland revenue depositing their revenues in another account, so that they can see where they're coming, where the deposits are coming from. And then at the end of the day, the bank sweeps all of the monies that come into one account, all right? And so that's a service that they offer to governments and other institutions. So the technology helps the bank to manage all of these different services, and it doesn't just help them to manage them, but it helps them to offer a range of services to their larger customers, all right? And everything, so all of this in the past was manual, now it's electronic. So that's the technology. In terms of when you look at the technology that's used, you have what they call treasury management software. Treasury management refers to where the cash is counted in the bank. So many years ago, Royal Bank had a system where the tellers only had a certain amount of cash in the front, all right? And every time you withdrew money, they had to go to the treasury to get the money. So the treasury is just in the back of the tellers, and they would go to the treasury window, and they give the voucher, and the treasury would disperse the funds. So they wouldn't have the cash in front of them in their tills. Electronic data interchange, and for them, again, it's work that they're doing on behalf of companies. Facilitating B2B e-commerce. B2B e-commerce means business to business. So if they would offer services to businesses where they would make payments on behalf of the business. So you pay one business, makes payment from one business to another, all right? So the company wouldn't have to write a check to do this. They do it all by electronic transfer. Then you have electronic billing, verifying identities. So they have their system for that. You have they have your picture in their database. So when you go to the teller, right, and you, so for example, again, systems change. So the Bank of Nova Scotia, you would go to the teller when they were here, and you would push your debit card, ATM card into their machine. When you push that card into the machine, right, the teller on the other end sees everything. So the teller is going to see that it's you. All right? The teller is going to see what your signature looks like. The teller is going to see all of your accounts. And then you tell the teller what it is you're going to do, and you tell the teller you want to withdraw $500. The teller puts that in. The voucher, which is slip of paper, is generated. You sign it, you give it back, and that's how the transactions are done. So verifying identities. Law enforcement has access to law enforcement. Doesn't necessarily mean the police. Law enforcement means any agency that regulates, any agency. So for example, the ONDCP. Who's aware of the ONDCP? All right. How many people are aware? Let me see. Put your hands up. So not everybody knows about the ONDCP. Okay, so the ONDCP is a law enforcement agency. What does it do? Carry on.
They basically search for things like fraud and so forth.
They search for fraud. What's their principal activity, regulatory activity? Anybody knows? Money laundering, yes. Okay? Right. So principally money laundering, and then because money laundering is often money laundering, financial crime period, because it is often connected with drugs, illicit activities, they normally end up being involved in drug seizures, drug busts, and so on, right? So they're a law enforcement agency, and so they would have access to that data. They're not going to have access to it looking at it, like looking into your account in that way. But there are reports, and there are, so the bank system would flag certain transactions and so on. So if you go to the bank and you're making a deposit of anything of $10,000 or more, sometimes even $5,000, they ask you for to fill out a source of funds declaration. So that's on file in the event that an investigation needs to happen. All right. Assisting small business entry into e-commerce, I spoke about that. Online customer facing technologies, cloud computing. What's cloud computing? Did I last semester, maybe remember? What's cloud computing? Cloud, CLOUD computing. Storage of information is on a cloud as opposed to a physical server, a physical computer, hard drive. How many of you use Google Docs? That's cloud computing. All right? You're saving your files in Google, that's you're saving it to the cloud, which means you always need the internet to access it. All right? So that's cloud computing. And so financial institutions use cloud computing for backup. All right? Use cloud computing to store their files. This goes into the impact of information technology on wholesale and retail banking. Remember I said wholesale banking is more businesses, retail banking is normal individual customers. And so IT is used to access a lot of the services. So ATMs, point of sale systems, tablet banking. You know what tablet banking is? What is it? That's like when you go into Scotiabank had it, where you were able to go to the kiosk and use a tablet and do your transaction. Pre-authorized debit cards, okay, or pre-authorized credit cards. So you load your if you have children and they're going to university and they're not old enough to have a credit card, you can get a pre-authorized credit card where you actually put the money on the card and it acts, they use it as a credit card. But of course, there's no credit, you have had to put the money on. It's like your debit card, but the money, you give it to your child if the child is on the age. So here, you can't open a bank account if you can't have an account and doing transactions if you're not 18. But we also know that we tend to finish school here at 16, 17. High school and secondary school, right?
Maybe 18.
Huh?
I think 18 when you finish, right?
No.
But okay, I'm on.
All right, let's do an exercise. You don't have to answer if you don't want to. So, most people here are in level 3, most, right? Okay, all right. Level 3 means that you close to your bachelor's, right? If you were 18 when you finished school, it means that most people in here are 22, 23. Okay, 24. How many people in here are younger than 23? Okay. See what I'm talking about? Turn around.
No.
No, you, I'm telling you.
Really?
Turn around.
Okay, wow.
I don't know about the other islands, but in Antigua,
Yes.
a lot of people finish school at 16, some finish at 15.
Okay. Yeah.
All right?
Same as St. Vincent, actually.
Okay, right. So the 18, so you finish school, you can work, right? When you finish secondary school, you can work a lot.
So they want experience.
And she took a break. So mind your business.
No, she's minding my business. I need to know why she thinks she has.
All right, so the point is, you can't open a bank account if you're not 18. And then when you're 18 and you try to open the bank account,
Job
you have
letter?
to have what?
A
You have to have a job letter. All right, oh, they tell you that too? So you have to have a job letter, right? You have to have IDs. Not everybody have their license at 18, so they don't have a driver's license.
Open it for you, and they under their account, just
They can-
separate.
No,
Just separate,
they-
Not
like,
everybody.
account and so on.
No, my experience is that I had to give my youngest daughter my bank card
True.
to an account for her to survive outside because she went overseas, right? They told me I could not open a bank account for her and she couldn't have a debit card. So she was in university 2 years before she got a debit card. Before I could add her to my account. But she went straight. She went straight to university. Right? Let's not get into that there, why she went straight. Yeah. So you can buy these pre-authorized cards, like a gift card. You're familiar with gift cards? Amazon,
Yes.
right? So it's
Okay.
something like that, right? So the technology helps with these things. So you have mobile banking, online banking, mobile banking, of course, your phone, online banking. I call it the same thing, but just that, it's pretty much the same thing. Although what you can do with mobile banking, you can't necessarily do with online banking. All depends. Then you have, well, they've changed their systems to all mobile banking. when before mobile banking it was online, and you could download your statements and so on, right? When mobile banking came in, you couldn't do that from your online banking, but they fixed it. They fixed it. I'm saying, but there was that period that you couldn't. I think because we're just behind the times, but and we spoke about these already. Smart cards, social media sites, integration of online, offline, and mobile channels. Then you have financial planning services, where the banks are, financial institutions, investment banks, and so on do financial planning, and even some of the insurance companies do it. But now commercial banks are now into financial planning as well. Then you have instant micro mobile loans. What's that? You can borrow small amounts, all right, and it's available on the phone. We don't have it, we don't have it yet, but yes, all right. Then you have loyalty programs. For example, you have a ECAP credit card, you can get American Airlines miles based on your purchases, that's all.
And I think British and CIBC.
Huh?
The British one at CIBC.
British, Germany?
Yeah.
Oh. All right. Okay. And then this speaks to the effects of technology on revenues and costs, and so it really just focuses on what investments in technology can do, which we would have spoken about most of it really. However, some innovations may not attract sufficient business, all right? And so you spend a lot of money on the innovation and you don't attract the business. And it is part of the reason why, because our population is relatively small, our banks here wouldn't offer the same services that you get overseas. So, for example, in North America, and well, North America I'm familiar with, you have things like Cash App and Zelle, where you just, it's a fintech service, it's not a bank.
Yeah.
You just move money between. I mean, they're bank affiliated because the service providers obviously have to have a bank account, right? And then where you can just send the money to somebody very easily with your phone, which is, and it's not a, you have to log in and get the password and get the code and all of that to be able to move the money. But a lot of the products are, they're expensive, the technology is expensive, and so if the bank doesn't have the critical mass, it wouldn't make sense to offer that, that product. So that's why we are not seeing some of those. So the innovations, we tend to be a more cash-driven society. I'm hoping that you, as the younger ones, you do a little bit more electronic than the older people do. My mother still refuses. She has a debit card. She refuses to use it. She go in the bank. She go in the bank and go in the line. And I don't consider her old. So, you know, but yeah, we tend to prefer to have cash. I like having cash. All right. Innovations may turn out to be negative net present value projects. What's that? How many people do it FM2? You know about net present value? Should have done it in FM1. That's why I asked how many people did FM2.
I know.
Net present value. What does that mean?
It means that a series of cash flows will be worth taking on investments, basically.
Yes. The cash flow. Okay, you have some cash flow and the investment, but what's the link between there?
Okay.
The net present, if the net present value is negative, it means what?
it's not worth
It's not
it's
worth it,
taking on the
you would reject the
investment.
project because the cash flows from the project are going to be less than your investment,
Investment.
initial investment, right? So some innovations may turn out to be negative net present value projects. And again, there's uncertainty on the revenue they'll get from it and the cost. Then financial institutions have to also think about how that investment in technology, if their competitor can invest and end up taking over a particular market because they have more resources or they have more qualified persons that can utilize the technology better. So potential competitive responses from the rivals may be another problem. So that is all risk. The point we're making is that those are all risks. Managers-oriented, growth-oriented investment versus the stockholder value maximizing objective can be in conflict. Agency problem. Y'all saw that yet?
Yeah, you know about it.
Agency conflict. Ever heard about that yet?
Yes.
I know you all supposed to hear about it. You just don't remember. Okay. All right. And we spoke about potential negative NPV projects due to uncertainty. We spoke about all those things. So these slides are the textbook slides, right? So these are not my slides where I go in and pull out what I want. And so if you see me skipping through, it's not because you're losing any information, but it's because I don't think that that's the most critical thing to be talking about at this point. Okay, or because of how I teach, I tend to talk ahead and would have covered what's on the slide already, right? And just to note, for the 2005 students, you know, your slides may look a little different, right? Once you get them. So I skipped through that one because I just spoke about more technology innovation and how it can reduce costs. Then you have the concept of economies of scale. So that's one of the effects of technology on revenue and cost. So economies of scale suggest that the unit cost or the average cost of producing a particular service decreases because you have more customers that you're serving. All right, that's my explanation. It's not necessarily what's on the slide. And when you have the economies of scale, the large investments in technology that creates economies of scale for larger banks, sometimes those larger banks will crowd out the smaller banks because the smaller banks don't have the resources to invest in this technology. So sometimes you could eliminate some of the smaller banks. What you will find some smaller banks doing is to find little niches that in the market that they will become expert at, right? So, for example, at the time when your ACBs and your ECABs weren't paying attention to small businesses, CUB was doing that. CUB was helping the small business customer. Now that ACB and ECAB are bigger and they recognize the value of the small business customer, whether by will or by force. Well, ECAB I think was more by force because Scotia had a lot of small business customers. So they came with the Scotia business. You find now that they are able to offer better services to the small business customer.